This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manassero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast and subscribe. Well, we have a great show for you here today. We have a returning guest, a gentleman who introduced us, back in, I think, 2016, 2017, to solo 401ks, self-directed solo 401ks. So I'm going to have a link to that show in this show notes that we're doing, but he's going to give us a broader scope this time and talk, about other creative ways and other things that we can do with our investing to protect us from taxes. And we're also definitely going to address solo 401k as well in that. So I'm talking about Dmitriy Fomenchenko. And Dmitriy is the founder and president of Sense Financial Services, LLC, a boutique financial firm specializing in self-directed retirement accounts with checkbook control. And I'll really emphasize that because he does. And he began his career in financial planning and real estate investing in the year 2000. He owns multiple investment properties, or maybe a handful of investment properties in various states, and is a licensed California real estate broker. But now today he's doing more passive investing in the way of private lending and multifamily syndication investing. Dmitry founded Sense Financial Services to help his clients maximize their returns on investments while protecting their hard-earned money. He is very passionate about helping families and individuals achieve financial freedom by following proven biblical principles of financial planning and investing. Dmitry lives in Southern California with his wife and 13-year-old daughter. He is an active member of Kindred Community Church in Anaheim Hills, California, where he serves in men's ministry. In his spare time, he enjoys studying systematic theology, spending time with his family, and visiting new places. Well, Dmitry, welcome back to the Old Dogs REI Network.
Bill, thank you for having me back. It's a joy to be visiting with you again.
Oh, well, it's great talking to you again. I'll tell you, it's been too long, and I definitely have to stay in touch more often here because you've got some great information for our listeners. Just besides being just a great guy, you've got a the people that I've referred to you and have always raved about you and the service and everything else you've done. And so I thought maybe you'd come and share more of your expertise, because I'm always asked about self-directed accounts. People say, "Hey, can I do this from a self-directed account? Can I, And so and there's so many different types of self-directed too. So I thought maybe you could bring some clarity to that. And but first, before we get started, just kind of, it's been a while since we last talked. I just wanted to get updated and see, what new things may have happened since we last spoke.
Well, not too much new. I continue to invest personally, like you mentioned in the intro, and based on our pre-chat before the recording, I shifted my investment strategy more towards passive investments. I enjoy that aspect, and I'm sure your listeners can relate to that. But just continue helping a bunch of folks take control over their IRAs and 401ks.
That's great. That's great. Well, they're self-directed. Just okay. The term itself is, maybe you can just kind of clarify what is a self-directed account, and what types are there?
Sure. Well, first of all, self-directed term might be misleading. Sometimes when you talk to, a brokerage, Fidelity or Schwab, they might tell you, yes, we can give you, or we can set up a self-directed IRA for you, self-directed account. And it's not truly a self-directed, because it will be a self-directed in terms that they can set up an account and then you can invest in their offerings with that account. But those offerings still will be limited to only stocks and mutual funds. So basically you can trade stocks using that quote-unquote self-directed account, but the true meaning of self-directed account is that you don't have investment limitations like a brokerage account will place on you. A true self-directed IRA or self-directed 401k means you have unlimited investment options. You can invest in things like real estate. You can do, you can find a private loan from your IRA or 401k. You can invest in multifamily syndication. You can buy that piece of property in your 401k. And you certainly cannot do that with a brokerage account at Schwab or Fidelity. So that's why it's not a truly self-directed account. So it's important to understand that distinction. And when it comes to different types, yeah, there are different types. So the one that most people, most investors are probably familiar with will be a self-directed IRA, where an account, an IRA, is opened with a custodian that does not place limitations on investments. So with self-directed IRA, at the custodian that, and I'm not talking about Schwab or Fidelity, not one of those major custodians who only offer stock investment. The self-directed custodian will not have those limits, and you can use your IRA to invest in real estate and other alternative assets. Now, the way the self-directed IRA works is, again, there is a custodian, and the role of a custodian is to hold assets of your IRA. So the custodian will hold cash initially when you create and fund that IRA, and then they under your direction, they will hold the assets, a property. So for example, if you buy in a property, investment property, let's say just a single family home, the custodian will take the title to the property, and it's going to be something like this. ABC Trust, and that's the name of the custodian, ABC Trust, custodian, FBO, which stands for benefit of, and then John Doe IRA, an account number. So something like that. So the custodian actually holding the title to the property for the benefit of your IRA, which is ultimately for your benefit, the client.
Just a quick question on that,
yes.
too. So a lot of investors, they'll put their properties in LLCs, for example. Can would the custodian still would it say FBO, but then list the LLC, or does it always have to be an individual at that point?
Well, if you buy a property in your IRA directly, no, you cannot have an LLC there. The LLC comes with basically a second, I guess, an IRA, self-directed IRA on steroids, and another name for it will be a checkbook IRA, or also it is known as an IRA LLC. So in this case, then rather than using a custodian to make the investments, a special purpose single member LLC is created. This LLC is owned by the IRA, so IRA owns this LLC, and then the client becomes the manager of the LLC. So as a manager, client controls this. So in this case, again, once this a structure is created, then IRA custodian is instructed to invest into that LLC, or technically speaking, buy 100% of the LLC units. So if you have an IRA with $100,000 or $200,000, you fund that IRA, and then you instruct a custodian, rather than buying a property or any other asset, you basically buying this asset, which is an LLC. So in this case, again, it is a single member special purpose LLC. It's designed specifically to be owned by the IRA, and then all the IRA balance is transferred into the LLC checking account, and you as a manager of the LLC basically controlling that. So then in turn you can buy investment property or any other investments, and that's going to be in the name of the LLC.
Okay, I got it. So so it would be, for example, the LLC, it has membership in there generally, right? And so would the custodian have 100% membership? Would it be 50%?
Correct. Yeah, it's a single member LLC, and that means there is only one member.
Oh,
and
okay.
That member is an IRA. Well, as we talked just a few minutes ago, a custodian is in the picture. So custodian, as ABC Trust Company as a custodian for John Doe IRA will be holding 100% units of that LLC. So custodian on behalf of an IRA owns the LLC, but you, the client, is the manager of that. So custodian doesn't have any control over the LLC, but you as a manager and at the same time IRA account holder control the LLC. You have 100% control over the LLC. Now, the same rules will apply. There is a certain limitations. There are certain prohibited transactions that you must be aware of when investing with your IRA. So the same rules will apply, even though you're now shifting everything away from the IRA, because IRA owns the LLC, the same rules will apply and you must follow the same rules. But that gives you basically the ability to bypass the custodian. You cannot eliminate IRA custodian. And the reason is because IRS requires every IRA have a custodian. So IRA custodian is still there. They hold a single asset of an IRA, which is LLC, and then LLC in turn is controlled by you, and you can buy multiple assets in there. You can grow it there, and this way you don't need a custodian for every single transaction, and transactions are done as easily as writing a check.
So let me just, again, I'm sticking sort of with the basic self-directed idea. Okay, so I have, let's say I have 200,000 in an IRA, a self-directed IRA. I want to purchase a property. Okay, so I will take 100,000 out. I will buy a single-family home for 100,000, and then of course the title and everything would have to reflect the custodian and so forth. And then let's say the next month I've got rent checks coming in. Okay, now does this? Do they have to be? Generally people will write a check. Sometimes they give cash. Sometimes they give money orders for rent. How does that money have to be set up to sort of automatically go back into this account?
Well, if you're talking about custodial IRA, then obviously all the rent must go back to the custodian because custodian owns the property for the benefit of an IRA. So when the rent is coming back, whether the tenant pays rent to the property manager, if there is a property manager, which most likely there will be a property manager, and then property manager keeps the property management fee and sends the rent to the owner. In this case, the owner will be custodian on behalf of an IRA. So they will issue a check to whoever owns the property, whoever is on the title, which will be ABC, Trust Company, FBO, John Doe IRA. And that check is sent to the custodian, and check is then being deposited into the IRA custodial account.
So if you have, which most properties do, they have other expenses. For example, it could have a mortgage, it could have repairs, it could have lawn service. There's utilities. Now, how are those things paid? Do they have to go into the custodial account first and then are paid, or would let's say the property manager, if there is a property manager, would pull those funds out first and then deposit the remaining?
Well, if there is a property manager and you have an agreement with the property manager to pay the expenses, that certainly can be done. Property manager can pay the expenses and then withhold those expenses from the rent proceeds. But if there is an expense that needs to be paid, ultimately that is the owner of the IRA will pay for that. So if there is a property, if there is a mortgage that needs to be paid, then that will have to come from the custodial account. So, and the way it's done, or if there is any, maybe not a, whether it's recurring expenses like mortgage or property taxes or just a one-time repair bill, then you need to submit a request to the custodian. Because remember, you don't have access to the cash in your IRA. There is cash, but it is in a custodial account. To get that payment taken care of, you have to submit a request with the invoice or a bill to the IRA custodian, and then IRA custodian will issue a check and they'll make that payment. Now, each time there is a payment processed, then there is going to be a fee charged by the IRA custodian. And that's one of the downsides of having a custodian. Obviously, they are in the business of making money, and that's how they make money, by charging transaction fees. And also some custodians, they do charge fees for incoming deposits. So they might allow you, maybe, I think I know one, they allow you 6 deposits for free in a year, but anything over, they charge you like $10 for each deposit. So if you have multiple properties and you receive rent every month, that may add up. And that's actually one of the main reasons why people go the checkbook route. The LLC route is to avoid those transaction fees. But also on top of that is the convenience of not having to go through the middleman.
Now, this may sound like a dumb question here, but like my IRA in the past, there's like a $6,500 maximum I could contribute to it during the year. I don't know if that's changed or not, but this is way back when. Is that impacted by, let's say the rents are more than $6,500 as they come in? Does that impact that limit?
It's actually a pretty good question, Bill. And the answer is no, it does not, because the rents that come into an IRA, those are not contributions that you make to an IRA. Those are simply your investment. They produce an income, and that goes back into an IRA. Just like, think of your IRA owns a bunch of stocks, whether it's just bunch of stocks or mutual funds, and those stocks, they pay dividends, and those dividends, they go back to an IRA, and that does not impact your ability to make a contribution. And by the way, the contributions have been raised since the time that you mentioned those amounts. So actually, this year you can contribute up to $6,000 to an IRA plus $1,000 catch up for a $7,000. So it's slightly higher than $6,500. So $7,000 will be the current limit. And I mean, think of it this way: if you have an IRA with $1 million and you just get 10% return on that, that's $100,000 in investment return. If the contribution is only $6,000 or $7,000, what do you do with the difference? So no, it does not affect. Your IRA can increase in value by $1 million if you can generate that much investment return, and you can still contribute $7,000 to it.
Got it.
So there is a limit on contribution, but there is no limit how much your IRA can increase in value from the investment.
Got it. And like the Roth IRA, a lot of people like that because its limits are higher, right? Is that true?
The limits are not higher. The contribution limits are not higher in a Roth IRA. It's the same.
Oh.
$6,000 plus $1,000 catch up. So that's total limit for an IRA. And you can put $7,000 into traditional, or you can choose and put that into Roth, or you can split, but it's total $7,000 for a year.
So what is the advantage of the Roth IRA?
The advantage of a Roth IRA is that you pay the taxes up front, so it's a post-tax. You make after-tax contributions, and then your investments are also growing tax deferred. You're not paying any taxes on any growth, but then when you take qualified distributions from a Roth IRA, they do come out tax-free.
Got it.
So traditional IRA, you get a tax break when you do make a contribution, so that reduces your taxable income, and it grows tax deferred, and then you pay taxes at a later time, which is still good because you're growing your wealth in a tax deferred environment. You're not paying any taxes on any gains, but you have to pay the taxes eventually. But if you can afford to pay taxes now, think of this concept: paying taxes on the seed or paying taxes on the harvest.
Right. Good way to look at it. I like that. Sometimes, especially rental properties can get kind of, complicated in that you do have all types of expenses. Let's say a person is an out-of-state investor like myself, and I have properties in right now in Georgia, Memphis, and Indianapolis, and if I need to go out to to that property, for example, it's on my taxes, it's considered a business expense. That my airfare, my rental car while I'm there, would be a valid business expense associated with the profitability of that particular property, what have you. Can somebody access those funds, for travel like that? Can they access it, for repairs on the property? Are there limits to what they can, what's legally acceptable, right?
Yeah. Mm-hmm. This is an excellent question, Bill, and excellent question. It does come up once in a while. So the answer is this: if you have a self-directed IRA or a 401k, you can invest in alternative assets like real estate, buying a rental property. But also you must understand that there is certain limitations, and most of those limitations comes in a relationship with disqualified persons. So first, you need to understand who the disqualified person is. And the disqualified person is the account owner. So you, Bill, if you open a self-directed IRA, you will be disqualified person to that IRA. Also your spouse, your kids and grandkids and their spouses, as well as your parents and grandparents. So immediate family members will be considered disqualified. Now you can go sideways, and that's easy way to remember. Vertical line is not okay, but horizontal line like a brother or sister or nephew or or uncle or cousin and so forth. Horizontal line is okay. So those extended family members are okay. You can deal with them. Now, let me give you a couple examples of prohibited transactions. If you are a real estate agent and you want to buy a property in your IRA, the IRS rules say that disqualified person cannot provide any services to the plan, to the retirement plan. So you cannot act as a real estate agent for this particular purchase. You have to hire somebody else to help you with that purchase, because acting as a real estate agent would mean that you're providing services to that plan, and that is not allowed. And also, when you act as an agent, you will receive compensation, and receiving a compensation as a result of transaction involving your IRA will be considered prohibited as well. So that's one example. Another example, if you're, let's say your father or your son is a handyman and you buy in a property that needs repair, you cannot hire your son or a father to do any work on that property. That will be disqualified, even if you pay them a fair amount, a market amount for that, for those services. And then one more example, let's say you buy in a rental property and you have your daughter going to school, going to college in that city. Well, you can't rent it to your daughter because your daughter is a disqualified person, and she will benefit from living in that property, even though she's paying maybe a fair amount. So that will be considered a prohibited transaction. But now getting to your question, normally if you are own a property personally in out of state, and you wanted to go and maybe do some inspection on the property or maybe even some of the work yourself, you can do that. But when you are buying this property inside of your IRA or 401k, you cannot provide any services. So, if you wanted to fly out and see the property, you can do that. You can't pay for it from an IRA though. I mean, think of it this way. If you have just a normal IRA at Schwab or Fidelity, and you considering buying stock of a Microsoft or Apple, can you fly to the city where the headquarters of that company is and maybe meet with some board members and some management of that company to make a decision, invest in that company or no? You can, but you can pay from your IRA. I mean, again, if you have a Schwab IRA, can you pay for the airfare and lodging and rental car and so forth? No, it's not related in any way to your IRA. If you wanted to pay out of pocket, you sure can, but that won't be IRA expense, won't be legal IRA expense.
Gotcha. Wow. Well, the checkbook aspect you talk about, and I know that from before when you were on, we talked about solo 401ks. I just really thought that that seemed like sort of the ideal instrument for real estate investors. How does that contrast to these other types of self-directed accounts? Sorry.
Yes, solo 401k, first of all, it's not for everyone. While anybody can set up a self-directed IRA regardless. I mean, if you have earned income or if you have balance in another IRA, you can open self-directed IRA and move that IRA over and then start investing. A solo 401k, on the other hand, can be self-directed as well, but it's a retirement account designed for those people who are either self-employed or own a small business without full-time employees. So, and there's a lot of people who will fit into that, but it does require presence of legitimate self-employment activity or a business without full-time employees. And IRS definition of full-time is 1,000 hours, which is about 20 hours a week. So you can have part-time assistant or part-time worker working for you under 20 hours a week or 1,000 hours a year threshold. But if you are eligible, if you qualify, then solo 401k offers some great benefits. And one of them is solo 401k does not require a custodian. So there is no need for a custodian, and there is no need for the LLC to gain the checkbook control, because it's set up as a trust with you, the client, being the trustee, and that's what gives you checkbook control. And custodian is not required. So that actually significantly minimizes the cost, because you're eliminating custodian out of the picture. There is no transaction fees. Also, one other benefit that many self-employed people struggle with, one of the challenges is the taxes. If you're doing well in your business, if you're making money, then you're paying a lot of taxes. But solo 401k offers those who are self-employed or own a small business ability to contribute up to $62,000 per year. I mean, compare that with $6,000 or $7,000 to an IRA, so it's nearly 10 times higher. And now, if you're a husband and wife running a business together, then you double that. You can potentially contribute over $120,000 of your income into a solo 401k, effectively lowering your taxable income, sheltering over $120,000 of your income from taxes. I mean, that can be a huge effect on your bottom line, because if you're sheltering that much income, that means you're lowering your taxable income by that much. And that's probably going to shift you into a lower tax bracket. So you're going to pay less taxes in a smaller tax bracket. So, it's not uncommon for folks to save $30,000, $40,000, $50,000 in taxes if they're maximizing this vehicle.
God, that's amazing. I think that's what makes it so appealing. But I've had people ask me too. They say, I'm a W-2 employee. I would love to get a solo 401k, but don't think I can because I have a full-time job. Is that the case?
Just the fact that they have a full-time job doesn't really make any difference on whether you qualify or not. Again, the criteria to qualify is having a presence of legitimate self-employment activity or a business. And if they have a full-time job, but they do something else on the side, if they generate some self-employment income on the side, then they can set up a solo 401k regardless whether they have a full-time job or not. And let me give you, Bill, a couple of examples of who might qualify. Well, you might have a full-time job, but you have your real estate license and you sell, maybe you can help a couple of people a year buy and sell real estate, or maybe you even do it for yourself. If you're a real estate investor, you have a full-time job and you have your license and you just basically do it for yourself and the family. And you just do a couple of transactions a year for yourself and your immediate family, then guess what? That's a legitimate self-employment activity that will make you eligible. Another example can be somebody who has a full-time job and they flip properties on the side. They might flip 1 or 2 properties a year. That creates legitimate self-employment activity because flipping is an active business, essentially. Or another example is I have a client who's a nurse, who works for a hospital, but also actually contracts with another hospital on the side to offer his services. So he's actually essentially getting a 1099 income from another hospital, which is a self-employment income that he reports on his Schedule C as a self-employment income. And that is enough to qualify for a solo 401k. The bottom line, you have to have some legitimate self-employment activity with earned income. And number 2, absence of full-time employees working for you.
If you have that side job, is there a certain number of hours required or anything? It just has to be. Does it have to be a licensed business? How do you classify that?
It doesn't have to be, licensed, and licensing, that's something that is again a requirement that might be on the local level. You might need a license to do certain things locally, but it's irrelevant from the 401k eligibility standpoint. Again, if you're flipping 1 property a year, you don't need a license. But if you want to help people buy and sell real estate, you do need a license to do that. So it does depend. Basically, it needs to rise, the activity needs to rise above hobby level. So one example is, if you're a photographer and you like to do that, kind of as a hobby or maybe a side gig. But if you did one wedding in a year and you generated $500, but you spent $1,000 in expenses on that, whether you buy the equipment or maybe you have some travel. And so if there is no income, then it's not really a legitimate business. It's more like a hobby, which, again, you might have a negative year, 1 year, but then next year needs to be a positive. You need to generate profit to show that it is not just a hobby. You can have a hobby and show negative income, but if it is a business, you're in business to make profit. That's the bottom line. And actually, IRS has a good a page or an article on that. Anybody can just Google IRS hobby versus business, and they can see the distinction. So it needs to rise. But if you're generating profit, if you're doing something and you show a few $1,000s of profit as a result of that activity, that's a legitimate self-employment business you have.
Oh, that's great. So you could have a full-time job, a W-2 job, and if you are doing some sort of business on the side, and it could be real estate, right?
Sure.
So if you've got a rental property and you're maybe the rent's $800 a month or what have you, that would justify it as a business. Therefore, you'd be able to have a solo 401k.
Well, that's another good question, Bill, because I do actually. This comes quite often. People come to me and say, "Well, I do have this couple of rentals, or maybe I do have this LLC with three rental properties in it. Will that be a legitimate business to qualify for a solo 401k?" And whether you have LLC or not is irrelevant, because 401k can be established by any business, and the business can be an LLC, it can be a corporation, can be a partnership, or can be just simply a sole proprietorship. If you're flipping one property a year and you're doing it in your name, there is no entity. It's just a sole proprietorship, and that qualifies. But when it comes to rentals, rental income in and of itself is considered passive. So if you do have a rental property or two or three even, and you generate rental income, that is not a business income. It's not an earned business income. Rental income is passive. So that in and of itself will not qualify you for a solo 401k because rental income is considered passive.
I got it. Well, this is great. This is such good information. What about, let's say somebody wants to borrow against their account? Is that something that people can do with any kind of self-directed account?
Well, there is no such thing as borrowing from an IRA. If you have an IRA, you can't borrow from it. There is no such thing. I mean, if you take a dollar from your IRA, that's a taxable event. But a solo 401k does come with ability to borrow from it. So just like any other 401k that you might have at your work or your previous work, and there is a loan provision. So solo 401k allows you to borrow up to $50,000 or 50% of the balance in your 401k, whichever is less, for any reason. So if you do need cash and you have that cash in your 401k, you could potentially take a loan from it. It's a 5-year loan, needs to be repaid over a period of 5 years using amortized payments. But yeah, you do have access to those funds if you ever need it.
And there's no requirement for what that would be spent on. It could be whatever purpose you want.
Correct. Yeah, the loan can be taken for any reason. I mean, it's a great benefit, but you need to be careful and not just run out there and start taking loans from your 401k. Because remember, if you have a 401k or an IRA, the purpose of that is for you to build wealth that then you can spend during your retirement years.
Right.
And so, and one of the great benefits that 401k and IRA offers is ability to grow your wealth in a tax-deferred environment. I mean, just very quick example. If you have $100,000 invested in a taxable account and you generate 10% return, that's $10,000. Well, if you're in 30% tax bracket, 3,000 of that is gone. You pay that to Uncle Sam, so you only have $7,000 left after you pay the taxes. But if you do the same investment in your IRA or 401k, you've got the entire 10,000 there that you can reinvest. And so you take advantage of compounding effect. So your investment returns are not minimized by taxes, so you can grow your wealth much quicker. Therefore, if you actually take the loan out of your 401k, then you're minimizing the potential for the growth of the 401k. So don't take that lightly. You can always, if you need money and you have ways to borrow that, borrow it elsewhere. Don't necessarily use 401k as a first, primary way to access some cash. Use 401k to invest in a tax-deferred or tax-free environment. You ask about Roth bill. That's actually another benefit of the 401k, because if you have an IRA, a traditional IRA, you can also have a Roth IRA and invest tax-free, but that's two separate accounts. And each one of them can be self-directed. But with the solo 401k, the plan, if you set up this plan, you can have Roth account in the solo 401k. So it's actually one plan. You can have two types of money in your plan, Roth and pre-tax.
Really? I didn't realize that. Wow.
Yeah.
Wow. I'm learning more and more every time I talk to you. You mentioned too how you're a passive investor, and now can people invest in well, like you're talking about, either hard money lending, I mean, be a hard money lender, or invest in a syndication, for example, out of their self-directed account?
They certainly can, and that's how I primarily do that. Personally, I started as just a rental investor. I had over 20 properties at one point, but when I started this business, I kind of started changing my investment strategy, because it does take time and effort to manage properties, whether you doing it directly or even through a property manager. So I was introduced to private lending, and I made a couple loans, and one of them was unsuccessful, and I learned a lesson. And it actually ended up the end result was fine, because I ended up ahead of. I lent money, and that loan was defaulted, and then I eventually became the owner of that property that is worth more than what my loan was, and my rental income is twice almost comparing to the interest income that I received in the past. So it worked out just well. But I do, I've been doing private lending using my personal funds as well as my retirement funds. And in retirement, I think it's the best way to invest, because it's passive, number one. Number two, it's low risk, because your investment is secured by real property. Obviously, you have to do your due diligence ahead of time. That's crucial. And then number three, you get decent return. So I get double-digit returns on pretty much all of my loans. And then personally, I just, because investing in notes or being a private lender just increases your income, because interest income, there's no deductions for that. And so I started looking into what else can I do. And so basically for the personal investments, I started shifting back towards real estate, but now not individual rental properties, but multifamily syndication, which provide great tax benefits and also passive for me. That's what attracts me.
Wow. Well, this is great. I think that this is going to, give people some great information here. But I understand too that you have some information too at your website that people can go to and see how these various self-directed plans compare to each other and so forth. How can people get a hold of you? What's sort of the best way to reach you and find out more about your services?
I think the website probably be the primary method. You can contact me through our website, which is sensefinancial.com, and sense is like common sense, SENSE, so sensefinancial.com. You can we do have a lot of educational material there on our website, and you can contact us through the website, or you can call our office. I do offer complimentary consultation to all of your listeners, because obviously everyone's situation is unique, and it's simply not possible to cover every possible scenario in an interview like this, but we can talk one-on-one, and the number to reach our office is 949-228-9394.
Oh, that's excellent. Well, Dmitry, it has been great having you on the show. Thank you so much for coming in. Coming in, actually, just picking up the phone here or getting on Skype. But thank you so much. I really appreciate you sharing your expertise, and I think this is going to be of a great value to our listeners.
Yeah, I think we had a great line of questions that you came up there, and we kind of dive into, and I think it's going to be beneficial, and thanks for having me.
Oh, it's my pleasure. I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to listen, to join us, means a lot, and we really appreciate it. And please note everything that Dmitry talked about today, everything presented, and some of the links as well, will be accessible in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode with Dmitry Fomenchenko. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.